welcome to the Odyssey Showcase, Bridging the Gap Capital. In this webinar, we are going to learn from Odyssey how the supply chain credit facilities transforming access to finance in Africa, DRE sector. And we have a very lineup of speakers. I'm going to introduce Maxime and Piyush from Odyssey. And before doing so, I would like just to remind some housekeeping rules. The recording and the deck will be shared after the presentation. Don't worry about that. And also, we would advise you to use the chat if you would like to interact with the audience for networking, and to use the Q&A for questions. We will also have a poll in the beginning of this showcase, and also another poll at the end of the showcase. And I'm going to introduce Maxime, the VP of Revenue of Odyssey, who has 10 years experience in the South Africa solar industry. And he was also previously the head of commercial and portfolio at Emergence Energy and the head of marketing and Solar Direct. Max is passionate about Bill Tong and founder of Bill Tong Board. And they also hold a BA in business and postgraduate diploma in entrepreneurship from the University of Cape Town. And we also have Max Yon with us, who has 20 years experience across private equity, finance, and distributed energy. He was previously the CEO of Simpa Network, a solar financing company acquired by NG, and he's a chartered accountant with an MBA from London Business School. Thank you very much for attending this showcase with us. I'm going to hand over the speech to Max. Thank you.
Thank you, Salim. I'll share my screen now. Can you enable the screen sharing?
I did.
Okay. Piyush and Arwa, can you see my screen?
Not yet, Max.
No, it's coming now. It's coming.
Here we go.
Yes.
Okay. Well, thank you so much, Salim, and I want to thank AFSIA today for giving us the opportunity to present and to give us this platform to chat about access to finance in Africa. It's really heartwarming to see these webinars so well attended every time they're hosting with AFSIA. I think we've got a few hundred attendants today, so thank you to all of you who are taking some time out of your busy days to be with us today. As Salim mentioned, we're going to have a quick introduction about Odyssey. We'll start with an Odyssey intro. We'll chat about our supply chain credit offering, which we've been scaling in Africa and globally over the last few years. Then we'll move into a roundtable session with Arwa Tamim, Chief Commercial Officer of Empower New Energy. And lastly, we'll have plenty of time to have questions from the audience. You would have seen that we've shared a poll with the team already, so please take a minute or two to answer these two questions. We understand these webinars are generally quite single-sided. We can't make it as interactive as we'd like, and that's why we're using poll to gather information about you and somehow trigger a conversation this way. So Odyssey is a global procurement and finance platform dedicated to drastically accelerate capital deployment in Africa. We've been in business for roughly 10 years, and if you had to ask us what's our mission and what we really work for on a daily basis, it's really to solve the energy crisis. We're a truly global business. I am myself based in South Africa. Piyush is in New Delhi. We are staffed pretty much the width and the breadth of the globe, and we're all former bankers, EPC owners, developers, OEM, you name it. So we are able to really understand the pain point of the sector because we've experienced them firsthand, and it enables us to launch products in this market that are really dedicated to addressing these pain points. So with that in mind, excuse me, I'll move to the next slide. we've been really working across the globe over the last 10 years, as I mentioned. As you can see on this map, we work with, I mean, the entirety of the value chain, but we support companies, whether you are developing solar home systems, mini grids, CNI systems. We generally look at supporting this development, the width and the breadth of the globe. So how do we do what we do? I think that's the question we'll always get asked. We like to think of ourselves as working on the value chain rather than in the value chain, and act as enablers in this value chain. So the main stakeholders are financiers, equipment manufacturers, and solar companies. When we refer to financier, we refer to DFI or commercial banks. We've been working with the likes of the World Banks and others for some times, and some of you may be aware of Odyssey by being familiar to our platform that is used in Africa across multiple programs, RBF and tender programs, to name a few. We could refer to DARES, ASENS, the DESIM program in Madagascar, which is being launched currently. And we've been running the solarization program essentially over the last 10 years. And as we grow our footprint around the globe, we unpacked further pain points. One of them, and the main one, being access to finance and procurement. So that's the work we do with financiers. We also work with equipment manufacturers. Because of the scale of our operation and our global footprint, we've been able to build close relationships with tier one manufacturers and negotiate what we call most favored nations partnerships. These partnerships enable us to procure on behalf of our partners at the best terms and the best pricing. So when you procure through Odyssey, it is very likely that you'll get better pricing than if you have to be procuring on your own, and you get better terms. And we'll get into the details of what it means to you as a business in a minute. And lastly, solar companies. As I mentioned, we work with anyone and everyone who are developing, building, or operating assets, whether you focus in the mini grid sector, whether you're an SHS company, or a CNI business. We really work with all of you and have experienced financing projects of all scales and sizes. A few numbers about our business that will help you get a better understanding of the scale of our operations. To this day, we've got above 3,000 solar companies using our services. We are deploying $2.8 billion of capital. It's not only our equity, but it's capital we're deploying on behalf of DFI and large commercial banks. We have facilitated the deployment of 2.3 million solar systems. And lastly, we are managing 53 financing programs. The world map I was showing you 2 slides ago was just a footprint of all these financing programs. So now let's get into I guess the meat of this webinar, which is addressing our supply chain credit product. One way to define the supply chain credit product that we'll discuss today is to understand the reason why it was launched in the first place. As a solar company or as a developer, you are constantly engaging into procurement transactions with OEM in order to be able to build the projects for which you're being paid. And when you know that equipment procurement accounts for roughly 60 to 80% of your project cost, we act on the assumption that if you can really manage and control procurement and buy at the right price and the right terms, you are laying the foundations to build a scalable business. So for us, we've really decided to tackle this main challenge, which is practically the working capital challenges associated with the procurement of equipment in the DRE sector. So that's called supply chain credit. And with supply chain credit, we have another set of services named supply chain services. We have a fully fledged supply chain team, which is able to practically take products from point A to point B and support you in essentially ensuring that your product get delivered to sites, wherever the site is and whatever the product is. So without getting into too much detail about supply chain credit, it is a product designed to help you build more projects faster, but to be more practical about the execution of this product, what we would do is generally buy product on your behalf with the OEM with whom we have partnership, sell it back to you with extended terms, enabling you to take physical possession of the goods, build your projects, and extend credit simultaneously. The key difference here is that we only expect to get paid when you get paid yourself or your customers. So without further ado, I'll hand over the mic to my colleague, Piyush Mathur, who will be moderating the roundtable session with Arwa.
Okay, thank you, Max. Welcome all of you to this segment of our webinar, especially those who have joined us a little late. You just heard about supply chain credit product of Odyssey from Max, but in this segment, we are going to have a conversation with a special guest who has been a repeat user of supply chain credit and will then provide you her perspective on the product and how it has helped them. It is my pleasure to introduce Arwa Tamim, Chief Commercial Officer of Empower New Energy. Arwa is joining us today from Tunis. In her work at Empower New Energy, Arwa manages all commercial operations and activities, including project proposals, negotiating contracts, managing customer relationships. She's also responsible for identifying opportunities for new investments and developing strategies for increasing profitability and revenue. Arwa is an engineer by training and also an MBA, but then she also comes with business development chops, mainly from her experience early on with Norwegian oil company DNO, when she worked with both Norway as well as the Gulf region. As you can see, Arwa is in many ways a complete business leader and therefore our ideal guest for today, combining technical and commercial experience. So Arwa, welcome. To kick things off, can I ask you to tell us a bit about your company first, your mandate in Africa, and the type of projects that you're currently focused on? That'll just help our audience understand the vantage point from which you see the industry and from which you will be presenting your experiences today.
Absolutely, Piyush. Thank you so much for the introduction. And thank you for the invitation to this webinar. I'm looking forward to the next minutes and see how we can actually share our knowledge and our experience on working on the African continent and with Odyssey as well. So Empower is a Norwegian impact-focused investor. We are financier. We do the co-development of projects that are rather small to mid-size. We go up to 20 million USD as a financier in Africa. Our footprint currently is around 10 markets in Africa. They're rather, diversified in multiple aspects. And the sector that we are focused on, as opposed to other potential developer, is the C&I sector. So we only work with the commercial and industrial private sector in the African markets, and we provide equity investment for these opportunities. The work with Odyssey so far have been on multiple markets. We have a few case studies that they are very interested. And as a financier that has been very exposed to multiple issues when it comes to deploying capitals, due to also to the small size of these tickets, I think I can be a good case study for this collaboration. And I hope to bring some interesting insight to this table. You're muted, Piyush.
That's great, Arwa. Thank you. So this webinar is about supply chain credit, which Odyssey has designed to address the challenges that we heard from our EPC partners, both around procurement as well as financing. So on procurement, things like not being able to meet minimum order quantity requirements of OEMs, not getting competitive pricing, long delivery schedules, you get put behind the queue when it comes to manufacturing and delivery schedules, and practically meaningless warranty terms. But also similarly around financing, that banks, when you approach banks for working capital, you struggle to get anything out of them because they don't see any collateral on your balance sheet, and that's how they lend. So most EPC businesses are services businesses, as we know, and trading businesses, and therefore do not have a great deal of collateral to offer from their balance sheet. But then similarly, even when you speak with specialist lenders, they also struggle, because even though they can take a cash flow based lending view, the project cash flows by definition are so lumpy that they just can't get comfortable lending the whole amount. Even if they approve something to you, that'll be very small in relation to your actual working capital requirements. But that's our perspective. I'm quite keen to hear your perspective today, that what type of challenges do you experience when you're working with EPCs in your capacity as a developer? So you have contracted and identified a EPC partner, you have then approved the project and are close to signing the EPC agreement. Then what happens? Why is it that you experience delays? Why is it that things just get sort of more complicated than you originally imagined?
So, Piyush, I would like to take a step back, because I mean, this is the question is very tricky, because it's really case by case study. But let's take the big picture first. We are in a market that has the biggest resource. I mean, when I talk about Africa in general, the biggest resource potential in the world in terms of solar. 60% of the solar potential sits in Africa. There is less than 0.4% of the financing that goes to Africa on a yearly basis. The other markets are taking the leads for different reasons, geopoliticals, etc. And I think that fundamentally we need to acknowledge the main reason behind it. This market in Africa is extremely fragmentalized. We do not have the interconnection, the linkage between how we can have a decent regulatory environment, has secure financing, and the solid deployment at the same time. And there are markets that are emerging now that can present at least two of these potential solutions. So we do have more and more markets in Africa that are presenting regulatory environments that are more and more, let's say, streamlined for these businesses. Again, we are talking about rather small tickets here, small potatoes. It's like 5, 6, 7 million. So we need something that is rather streamlined from a process standpoint. And then we do have the access to the financing potentially based on the credit risk of the market, et cetera, et cetera. But then how we can have a solid execution. On these nascent markets, which I can qualify most of the African market we are talking with, the EPC contractor, we rightfully say, Piyush, do not have the financial capability to sustain the load and to carry the risk of the project from a financial standpoint. As an impact investor, our role is also to share knowledge and to bring this EPC contractor up to the standard that can actually learn and present a project that is solid, whether from execution or from traceability, reporting, ESG and HSE standpoint. So how would we do to actually de-risk that? The solution for us was in multiple instances ask for a bank guarantee, do things like that. But we know that these leverage are costly for these partners. We've been using Odyssey to actually de-risk the project, and that's how we call it, even in our investment committee. So by this partnership, Odyssey comes as an enabler to de-risk project for us as a financier. And I think that the first time I had a discussion, I think, with Maxime, I told them, you guys are looking at this business not as a value chain, but as a value network. And that's what we need in our business. And that's how the solar in Africa will move from the 0.4% that I earlier mentioned to something that actually reflects the potential and, most importantly, the needs of these markets. So I see myself as a financier today in Africa as an enabler. I suppose Odyssey is doing the same. But if we manage to work together, that's how we tapped into this huge potential of ours. I think that's for me the key message that I want to share. So in terms of the risks of execution, etc., we saw that there are a lot of things that we actually been following diligently. In the past, we used Odyssey in few of these deals. In one of them, we had even the equipment ahead of time, plus the cost optimization. So I think that the experience so far showcases that we actually need more enablers, and we need to work together to get into this common goal.
Okay, well, what you have just said would be very encouraging for a lot of our audience to hear, because many of them are EPCs. So please be prepared to receive approaches from all of them, because they like to discuss their respective projects with you. They now know that you are in the market for providing funding for these projects. Okay, so I think just to summarize, what you said was, first, the availability of capital itself for African markets is constrained. A very small fraction comes into Africa for all the reasons that we have historically understood. But the territory is regarded as high risk, generally speaking, by investors, and therefore the capital availability itself is stretched. But then you also need to mobilize capital for projects in Africa. You need de-risking mechanisms. And even though you yourself are a financier or a quasi-financier in your capacity as a developer, you still feel that you can benefit from supply chain credit as a product for de-risking your own exposure, particularly in the procurement and construction phase of the projects. That's great. Okay, well, let me touch upon another aspect of your work and your engagement with EPCs. So when you sign EPC contracts with your EPC partners, by that point, you've diligenced the client, everything is good to go, you've signed your agreements, you're ready to disperse. But then at that point in time, you just said that you feel uncomfortable releasing capital before the commissioning phase, because the procurement is unclear, uncertain, and construction risk is sometimes not easy to get one's head around. But then in that sort of relationship, you are putting the pressure of arranging that working capital on the developers, or sorry, on the EPCs, right? So they have to first now go and get that working capital from banks or specialist lenders so that they can proceed with procuring equipment. But that also gets stuck. So do you run into situations where, okay, you may not have used Odyssey supply chain credit in those specific projects, but have there been situations where you've been waiting for the EPCs to arrange working capital, and it's basically for want of capital that the whole chain is now getting stuck?
Absolutely. By all means, Piyush, we had the situation again. We need to acknowledge the landscape that we are working with the reality of the stakeholders that we are working with. First of all, let me tell you something very important here. The de-risking of the project and the fact that these partners cannot provide working capital is something that we potentially would go in with the eyes wide open. We do make our assessment of the partners. We do request securities and guarantees. However, we know the market volatility. We know what happened with the currencies in these markets. I name cases that have been rather extreme, like Nigeria, Egypt, etc. The last couple of years, we've been in the middle of these crises and the middle of the investments during these crises. So we are not actually, in addition to the initial assessment, we are not hedged during the execution. And I think that's the key point. So sometimes you can even start with an EPC contractor that has rather I would say, decent, solid foundation for collaboration. He can carry the financial risk and the execution risk of the project. He can deal with it, the decent references, etc. However, we know that these markets are exposed more than others to this volatility, and that's something that we need to think about in our risk assessment and mitigant implementation, or at least the thought process about the mitigants. We've been with partners that actually defaulted during project execution. We witnessed that as a financier. So we had, obviously a contract set up that actually allows us to have the project evolve in another direction. But to go back to the Odyssey intervention, whether it is in both type of services that you guys provide. The way I see it is something is very simple. From an EPC contractor, there is this apprehension of erosion of margin. That's the key point. And that's every time what we are when we bring this type of discussion that I want to keep my margin on the procurement at least, and then to execute, etc. And when I think about it, the key point that we need to bear in mind, I see that there is almost 200 people around this table today, is for us, even for me as a commercial person, I'd rather have a bigger part of a smaller part of a bigger cake than a bigger part of a small cake. So if I am managing to work with a financier or with a bank or any type of partner, and like being able to enroll projects in a systematic manner with the support of de-risking mechanisms like Odyssey or the hedging in some instances, etc., I'd rather do that than actually focusing on one project, want to carry it 100% over my shoulders, and then being able to argue about the quality of the execution. So that's a little bit my message here.
You are touching on some important points, and I want to delve deeper into some of those things later. But let's just sort of draw a line under the whole issue of delays for want of capital and delays for all the supply chain hassles. So let's also understand, I mean, have you probably routinely experience these kind of delays, but have you made any assessment of what type of consequences it has on you and overall project economics, and how that leaves even the EPCs sort of affected, and therefore there is a sort of hidden cost of delay which we don't sort of explicitly see, but when it happens, we are like almost in a bottomless pit. With every single passing day, we're losing money. Have you made any assessment of what those consequences are, both financial and non-financial?
Absolutely. So Piyush, remember, we are an impact investor. We are looking at projects that have rather in a net value, a single digit IRR. We cannot today present a project in these markets and for a 15, 20 years type of contract and not be able to compete with the grid, for instance, or do something that is extremely squeezed from a financial standpoint to provide economical benefit to the end of taker, to the consumer of the electricity. That's our value proposition per se. So if there is a delay, in which is, I would say, happening rather more frequent than not in some markets, obviously, the EPC carries a delay liquidated damages as per the contract, and every day of delay or every week of delay is computed in the way that Empower is not exposed into any type of difference in the IRR or decline into the IRR later on. So the execution for us as a financier is one of the key points here. Our early cash in is the most important cash that we can have during that 20-year contract. The first 2-3 years, if I am impacted in these 2-3 years, the impact of the IRR is rather huge compared as opposed to the last 5 years, for instance. Correct. So for me, the delay liquidated damage is a clause that we negotiate very, very deeply with the EPC contractor. We go in with the eyes wide open. I want all our partner to understand the criticality of this point on our minimum hurdle, and also the fact today that we present this type of equity investment is very unique in Africa. You know, I mean, we are not raising debt. Our projects are not diluted with some form of, you know, local currencies, etc. So the delay, in addition to the IRR itself, is also the exposure to the market and I would say unplanned events. So that's something that we are extremely sensitive on. And we want to make sure that our EPC contract understands before signing the EPC contract. And that's one of the critical points indeed.
Okay, fantastic. Well, part of the reason you are here, Arwa, is because you were among the early adopters of supply chain credit. You smartened up to this idea that you could use this credit to de-risk yourselves, but then it also doubles up as a working capital support to EPCs, helping everybody and avoiding delays and making sure that the project economics stay protected for everybody. Can you talk a bit about how it has helped you with some of the challenges that you just mentioned, both time and cost overruns, but also not exposing yourselves to risks which you otherwise didn't sign up to.
Absolutely. So first of all, the key point here, you need to assess your risk. I mean, you need to quantify your risk as a financier. It means that obviously any type of credit line or any type of services has a cost, and you need to make that genuine assessment of what is the intrinsic cost of this risk that I've been carrying on historical projects. And then moving forward, we will be able to say yes or no, this is something that we can actually address on the future one, and we can encapsulate as part of our value proposition. So that's a little bit the starting point that we actually looked at when we had the first introduction of Odyssey services. And we came to the conclusion that the cost associated with these services, based on the profiling of the EPC, obviously, and the market itself, would be largely justified on the credit, obviously, on the credit service standpoint. Yeah. On the procurement one, the cool thing, if I can say it about that service, is that you guys managed to encapsulate your margin within your negotiation margin already on the end product that you procure. So the project most of the time don't carry additional costs. I de-risk it for almost something that is rather marginal. So for me, the starting point was that based on the profile of my EPC contractor, what is my appetite of actually spending more money to the risk or less money to the risk? And in both scenarios, we found that these two offers kind of are complementary and can fit the different profiles and the different, especially, I would say, execution tendencies that we have now on these markets where we are.
Okay. Well, let me ask you two questions very specifically. So you routinely work with banks, other financiers. How long does it take you to get financing from those institutions?
So the setup of Empower, that we actually raise capital at our headquarter level. So in Norway, we raise the capital and we deploy the capitals on our SPVs. We typically don't raise capital in market level, right, Piyush? So I'm not going into the market and getting debts on projects on a specific project.
But you know how long it takes, right? It takes months.
And the reason why is I know how long it takes. That's what I'm trying to say. Exactly. So the reason why is that these cycles of actually raising the debt or working with different financiers in Africa, especially, of 9 months or so to get something that 6-9 months to get a financing solution. I mean, the market is extremely dynamic. Things happen.
What's been your lived experience of getting financing and getting supply chain credit approved by Odyssey? How long has it taken to get supply chain credit from Odyssey?
Maxime, I think the last one was 2-3 weeks.
I think it's 5 days, the last one, to be specific. Yeah, 5 working days.
Yes, the last one was 5 working days. Yes, absolutely.
That's right.
The one before was 2-3 weeks. I'm expecting the one that we are working on now. It will be one week to 10 days, right, Maxime? That's a little bit the timelines that we're talking about.
Yeah.
And if I may, I think that it's also a matching of profiles, because we do also deploy capitals in rather fast fashion. We do have the same investment committee proposals that you guys having. We are rather agile on these markets, small team deploying in different geographies, etc. So I feel that there is also these matching in terms of how we are organized to be able to deploy this solution, and how reactive we are as a team, I suppose.
Yeah, I guess the point I was getting to is that the supply chain credit process, or the process to get supply chain credit, is not exhausting and never-ending and loopy as you would typically find when you're raising capital from traditional banks or lending institutions. You can actually get it very quickly, and there is time efficiency as well, in addition to other benefits that we've spoken about. Let me also then quickly check in with you on another belief that we internally hold at Odyssey. We obviously measure this ourselves, but I want to check your lived experience as a client and user of supply chain credit. So we also pride ourselves in securing better pricing terms from the OEMs, because we are obviously aggregating quantities across a number of different EPCs and developers. So we're ordering sort of gigawatt scale equipment, whereas individually developers in EPC want maybe megawatt or kilowatt scale. So there are economies of scale, but then also because of our most favored nation partnerships with OEMs, you're able to achieve better warranty terms. So on-site warranty as opposed to carry-in warranty. And then similarly, replacement stock, all ancillary terms around pricing. What has been your actual experience when you have bought equipment from Odyssey? You briefly mentioned earlier, but I just want to unpack that a little more, that when you've bought equipment, what have you found? Obviously, there is a cost of credit, but I think you were suggesting that that cost of credit is sort of already included in the price. We are able to achieve savings which more than cover the cost of credit, and therefore the landed cost of the equipment is lower than what it would otherwise be. Is that right? Is that your experience?
Absolutely, Piyush. In all projects, with no exception, there is savings to break-even point. There is no impact on the financial model at all. So that's the cost of the de-risk. I mean, it's almost a de-risking that is not costing anything for us. That's the situation we have. I mean, obviously, you guys have the bargaining power and the quantities that you can actually play. I mean, I would say negotiate more your prices, but also you have this projection aspect that most financiers don't have on how the prices will fluctuate over the next 2-3 months, etc. And that's something that we're deeply lacking. I think in our conversation, we always tackle this point and try to pick your brains about how do you feel that the equipment costs will variate over the 2-3 months or so, and how we can plan our future projects, etc. So yes, so I think that's something that I can only confirm that these type of partnership for us are really something that de-risks for something very minor or no cost at all in the end of the day, actually, if you compute every charge of the project.
Great, thank you. Well, for those members of the audience who joined us a little late, I wish to sort of remind everybody that when we talk about supply chain credit, that supply chain credit is actually joined at the hips with Odyssey's procurement platform, where we have all the biggest OEMs in the solar sector for all different product categories, cross panels, batteries, inverters, BESS systems, offering their equipment with best terms guarantees. So when you procure equipment through Odyssey, you can buy it with complete assurance that you're getting the best terms that you would get anywhere. So in using supply chain credit, not only do you get credit to buy equipment, you also get best terms on the equipment, such that the landed cost of the equipment ends up being even lower than what you otherwise would get without any credit. So it's like a double barrel product which achieves two benefits at the same time.
Piyush, if I may, I mean, I think that this is very innovative, and that's why, I mean, I think that you're reiterating this to kind of explain how practically it is simple to implement, but in reality, it's rather innovative. But if I can take a parallel example here, you see the cost of batteries in the other region of the world versus the cost of batteries in Africa. I mean, we are talking about a huge discrepancy in the price. Africa is more expensive in battery. The costs are eroding right now, but we still have expensive access to storage as a continent itself. And the reason is that we don't have volumes in Africa yet for that product. And they think that if I can go back to the Odyssey intervention, the way that you guys are doing it, is you provide these volumes actually, and you provide this margin to discuss about these specific project. And as far as I am concerned, for again these type of small tickets that we are dealing with as a financier, we do not want to expose ourselves to the full the full work of the procurement as a financier and co-developer. We see that with our EPCs, they are very rarely, randomly bargaining power at some exemption, obviously, because, you know, of the nature of our market. And the fact that we can plug in procurement/credit partner that helped us a lot into achieving something that is more diluted on this partnership. So that's a little bit our situation.
Great. Well, I mean, that's very foundational to the vision that we have for the supply chain credit product, that we want to bring utility scale pricing and terms to a distributed sector. There is no reason why there shouldn't be equity across the entire solar sector. Okay, I want to come back and touch upon something that you were starting to mention earlier, Arwa. Many a times
sorry, Piyush. I would like just to remind you to be brief, as long as we are receiving many questions from the Q&A. I think it would be also better to address them. So just wanted to remind you about that.
We will wrap up very quickly now with the Q&A. So we'll move on to questions from the audience. But there's an important point that I want to pick Arwa's brains on. We often get asked, Arwa, that by EPCs particularly, that, hey, I also make some margin on procurement. So if I go through Odyssey, will I lose that? That sometimes becomes a barrier for them to also benefit from supply chain credit. What would you say to those EPCs in a couple of sentences?
Full transparency, and that's the way that we work, Piyush. We managed to keep the margin of the EPCs in some contracts, although that the procurement was not done by them. In some instances, we managed also to build a pipeline where there is more intervention of a procurement partner, where they get more deals. So a bigger part of the small cake I was telling about. So I think that the foundation of this partnership is a win-win situation. We get to the point that either the deal goes into a de-risking aspect or there is no deal at all. And I think that it's something that we need to acknowledge in order to actually, you remember the fragmentation I was talking about earlier, defragmentize this and get something that is more as a holistic view on how we can enroll these projects, enroll these investments, and make a successful partnership. And I think that's the key point that I want everyone to keep in mind, and how we were able successfully to deploy these capitals so far with also your help in multiple transactions.
Okay, so what you're saying is you are sensitive to EPCs' needs for margin, you treat them as partners, and you will make sure that their margins are protected and they're adequately compensated.
Absolutely.
Okay, well, this is an engaging conversation and we can go on, but we must end here. So all that's left is for me to thank you for taking the time today and be our guest and share your perspective. Thank you very much, Arwa. Over to you. Over to you, yeah.
Okay, thank you very much. This is the time to move to the Q&A. I can see there is a lot of questions here. We cannot address all of them, but we will make sure to address some. And if for the remaining question, we will share all the details with Odyssey so that they can directly reach out to you. So I'm going to start with the first question from Elodie, who is asking, does the platform provide financing solution and equipment for productive use, POE? I don't know.
The answer is yes. I can take that question.
The answer is yes. The answer is yes. So you will decide who among you will respond to the question, because I'm also seeing other people, they are using the chat to ask questions instead of using the Q&A, which would be a bit tricky for me to pick the question. I'm seeing one question here from the chat, but we'll get back to it after. We can take the first question from Robert, who's asking, are you working with solar companies only, or do you also do other generator technology like wind, hydro, etc.?
Our current focus is solar. We do look at other technologies like electric vehicles, storage solutions, but at this point in time, we haven't done much in wind and hydro. This is not to say that we will not be looking at those sectors down the road, but at the moment, our focus remains solar and storage.
All right. I'm going to take one question from Tom, who is asking, let me get back to his question. who is asking her how can them benefit from your solution?
Max, you want to take that?
Did you
Sorry,
get
do you mind repeat? Salim, I didn't get the question. If you can repeat, please.
the question is what specific enabling support mechanisms are being considered for greenfield utility scale projects to help them progress to ready to build status?
Well, I think it's worthwhile noting that we only deploy our credit facility and start procuring once against long-term financing. So we won't be able to support developers while looking for a loan to achieve RTB status. As soon as you've got your long-term financing secured and that you're ready to proceed with the build, but you may be experiencing working capital gaps at this stage, then we can support you, but not prior to that.
Okay. And there is Rakot who's asking, what about leasing and PPA model? Or it's only dedicated to EPC?
I think leasing and PPA model, that should be a question for Arwa specifically.
Yeah.
I mean, the contract or the structure of the contract with the end consumer is a leasing or PPA. What we're talking about is the intervention of the financing on this contract and the procurement and the credit services. So I'm not sure about what is actually meant by what about the leasing and PPA, but the fundamental contractual setup of these projects are leasing and PPAs model.
Yeah, again, I think there is one more question that I believe it should be Arwa can respond to it. There is an anonymous attendee who's asking if Empower accept a joint venture model in the financing.
If we are not diluted, yes. If there is a pipeline that justify a GV, yes. But if it's a single transaction that is actually bringing a JV constraints and I would say potential complication associated with that, I would be very reluctant to do it. However, I'm hoping to discuss specifics here and see how we can take this concept further. So in general, we are not opposed to that, but it's a case-by-case study.
Perfect. And again, another question that I believe you can jump in is asking, does Empower own the plants after development or remain as a financier?
Well, I mean, it depends on the market and the regulatory environments. In some instances, we do own the plant. Some instances, the ownership goes directly to the client from day one. Depends on what market are we talking about. Again, we are subject to these regulatory environments.
Okay, and there is Ibitoye who is asking, how do we access capital to assist consumers to access funding through Odyssey or other platform? Maybe Max or Piyush can respond to it.
I can take this one. There should be a link shared in the thread with all of you. So should you want to apply for a credit facility, you'll be able to do so directly from the link.
Okay. This is perfect. This is perfect. I don't know how many questions we are going to address, but there is a lot of questions both in the chat, also in the Q&A, and other people who are asking us questions on LinkedIn. Zainab was asking, can you share your experience specifically with Ethiopian markets? Piyush or Max?
I can take this one. Our experience currently in Ethiopia is limited, but we are looking at multiple projects there. So we are engaging with a number of developers in Ethiopia. But should you have a project specifically in Ethiopia, we'll be able to support you. Whether it's an RBF or a tender-led program or CNI system, we're happy to engage after this call.
Okay, perfect. And I'm going to thank everybody for attending this showcase event. And thank you, Odyssey and Arwa Energy, for providing this insightful information. I think we can hand this webinar here, unless Piyush, Arwa has anything to share. If not, I'm going to leave this event open for some minutes, and we can end it by here. Thank you very much for attending this event.